7. Smart ways to invest your money in 2026. Given today's economic conditions, is your money actually working for you? Or is it just sitting there slowly losing value while inflation quietly eats away at its purchasing power year after year? Let me ask you something that most people are afraid to ask themselves right now. Because here is the uncomfortable truth that Wall Street and the major banks would rather you not think about too hard. Keeping your money in a standard checking or savings account in 2026 is not playing it safe. It is actually one of the riskiest financial decisions you can make, because while your balance stays the same, everything that money needs to buy keeps getting more expensive. The good news is this: you do not need to be wealthy to start investing. You do not need a financial advisor charging you 1% of your portfolio every year, and you do not need to understand every complex financial instrument on the market. You just need a clear, simple strategy that matches the economic environment we are actually living in right now. Today, I am going to give you exactly that: 7 smart ways to invest your money in 2026 given the current economic conditions. Let's get into it. Welcome back to the channel. If you are new here, we break down real personal finance strategies for real people navigating a complicated financial world. Hit that subscribe button and the notification bell so you never miss a video, because the content we are covering this year could genuinely change your financial future. Step number 1. Max out your high-yield savings account, and in 2026, that starts with a high-yield savings account. First, before you invest a single dollar in the market, make sure your financial foundation is solid. Unlike a traditional bank savings account paying you next to nothing, high-yield savings accounts at online banks are currently offering interest rates that actually keep pace with or beat inflation, making them one of the smartest places to park your emergency fund and any cash you are not ready to invest yet. The rule is simple: keep 3 to 6 months of living expenses in a high-yield savings account as your financial cushion. This protects you from having to sell investments at a loss during a market downturn just to cover an unexpected expense. Think of it as the foundation that makes every other investment on this list possible. Step number 2. Invest consistently in low-cost index funds. If there is one investment strategy that has stood the test of time through recessions, market crashes, inflation spikes, and economic uncertainty, it is consistent, disciplined investing in low-cost index funds. An index fund is a simple investment that tracks a broad market index like the S&P 500, giving you ownership in hundreds of the largest companies in America through a single investment. Instead of trying to pick winning stocks, which even professional fund managers fail to do consistently, you simply own a small piece of everything. The key in 2026 is consistency. Do not try to time the market. Set up automatic monthly contributions and let dollar cost averaging work in your favor. Investing the same amount every month means you automatically buy more shares when prices are low and fewer when prices are high. A powerful wealth-building strategy that requires almost no effort once it is set up. Step number 3. Take full advantage of tax-advantaged retirement accounts. One of the most overlooked investment strategies available to everyday Americans is also one of the most powerful: maximizing contributions to tax-advantaged retirement accounts like a 401k or IRA. Here is why this matters so much in the current environment. Every dollar you contribute to a traditional 401k or IRA reduces your taxable income today, meaning you pay less in taxes right now while your money grows tax-deferred for decades. A Roth IRA flips that equation. You pay taxes now, but your money grows completely tax-free, which is an extraordinarily powerful advantage in a potentially higher tax environment down the road. In 2026, the 401k contribution limit is $23,500 per year, and the IRA limit is $7,000. If your employer offers a match on your 401k contributions, that is an instant 50 to 100% return on your money before the market does anything at all. Never leave that match on the table. Step number 4. Consider Treasury bonds and I-bonds as a stable hedge. In an uncertain economic environment marked by inflation concerns, trade tensions, and market volatility, having a portion of your portfolio in government-backed securities is a genuinely smart move, not a boring one. Treasury bonds and I-bonds are backed by the full faith and credit of the United States government, making them one of the safest investments available. I-bonds in particular are designed specifically to protect against inflation. Their interest rate adjusts twice a year based on the current inflation rate, meaning your return moves with the cost of living rather than against it. For conservative investors or anyone within 10 years of retirement, allocating a portion of your portfolio to Treasury securities provides stability and predictable returns during periods of market turbulence, acting as a counterbalance to more volatile equity investments. Step number 5. Invest in real estate without buying property. Real estate has historically been one of the most reliable wealth-building vehicles available to American investors. But in 2026, with mortgage rates elevated and home prices still near historic highs, buying physical property is out of reach for many households. The good news is that you can still access the wealth-building power of real estate without buying a single property through real estate investment trusts, commonly known as REITs. A REIT is a company that owns and operates income-producing real estate, apartment buildings, office complexes, shopping centers, data centers, and warehouses. When you invest in a REIT, you receive regular dividend payments from the rental income those properties generate. REITs are publicly traded on stock exchanges, meaning you can invest with as little as a few dollars through any standard brokerage account and sell your position at any time. It is one of the most accessible and underutilized investment vehicles available to everyday investors right now. Step number 6. Invest in yourself and your earning power. This is the investment that most financial channels skip over entirely, and it may be the highest returning investment you can make in 2026. In a softening job market where artificial intelligence is reshaping entire industries, the single most powerful thing you can do for your long-term financial security is invest aggressively in skills that make you more valuable, harder to replace, and capable of earning more income. That might mean earning a professional certification in data analytics, cloud computing, financial modeling, or digital marketing. It might mean building a side business that generates income independent of your employer. Or it might mean developing leadership and communication skills that position you for a promotion or a higher paying role. Every dollar you invest in your own skills and knowledge has the potential to generate returns that compound for the rest of your career. And unlike the stock market, nobody can take that investment away from you. Step number 7. Diversify internationally. Most American investors have almost all of their money invested in U.S. markets, a phenomenon financial experts call home country bias. And while the U.S. market has historically performed exceptionally well, concentrating 100% of your investments in a single country's economy is a risk that sophisticated investors actively manage against. In 2026, with U.S. economic headwinds mounting, international diversification is more relevant than ever. Emerging markets in Southeast Asia, India, and parts of Latin America are experiencing growth trajectories that are outpacing the U.S. economy. Developed international markets in Europe and Japan offer stability and dividend income from world-class companies at lower valuations than their American counterparts. Adding international index funds or ETFs to your portfolio, even just 10 to 20% of your total allocation, reduces your dependence on any single economy and positions you to benefit from growth happening anywhere in the world. So, there you have it. 7 smart ways to invest your money in 2026, given the economic reality we are all navigating together. Let me leave you with the most important thing I want you to take away from this video. The best investment strategy is not the most complex one. It is not the one with the highest potential return. It is the one you actually start, and the one you actually stick with. You do not need perfect timing. You do not need a lot of money to begin. You just need a clear plan, consistent action, and the patience to let time and compounding do the heavy lifting. The people who build real lasting wealth are not the ones who found a secret investment. They are the ones who started earlier than felt comfortable, stayed consistent when markets got scary, and never stopped investing in themselves along the way. Start with one step from today's video. Just one. Build from there. If this video gave you value, and I genuinely hope it did, please hit the like button right now. It takes 1 second and it helps this channel reach more people who need this information. And if you are not subscribed yet, now is the time. Hit that subscribe button and the notification bell so you never miss a video. We are publishing new personal finance content every week. Practical, honest strategies designed to help you build real wealth in the real world. Drop a comment below and tell me, which of these 7 investment strategies are you starting with? I read every single comment, and I would love to hear where you are on your financial journey. Stay consistent, stay patient, and I will see you in the next one.